Can FedEx hit $300 again? What's interesting about FedEx is that its margin is half of its main competitors, UPS. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this is not investment advice or a recommendation. So let's look at FedEx. It's listed in the industrial sectors in the U.S. It's a global courier and logistics company with a U.S. market share of around 37%. So market cap's about roughly 50 billion US dollars. Current price is 204. My value estimate is about 247, which is about 21% up from where it is right now. There's three things that you should know about this company. Number one, weak demand squeezes volume, requiring price increases to keep revenue on track. Number two, accelerating cost-cutting program makes margin expansion the key catalyst. And three, reducing capital spend could help to improve shareholders' return. Before we get into the story, let's understand the revenues of this company. So 49% of revenue comes from Express. That's priority overnight deliveries in the US and within a few days internationally. 35% comes from Ground, which is low-cost shipping service that delivers to small and medium-sized businesses and households. For most of us, that's the truck we're used to seeing. And then 10% comes from Freight. That's shipment of heavy, less than truckload and bulky items across all distances. Now, the revenue is 69% coming from the US and 31% coming from international. Now, I want to introduce you to my framework for forecasting free cash flow growth potential. Free cash flow really is a combination of two factors: the NOPAT, net operating profit after tax, and the investment that the company has to make. Let's look at that in more detail. NOPAT can be broken down into revenue and costs, and of course, investment means the capital we have to put into the business. Let's look at the first driver, revenue. Revenue is price times quantity, so we're going to go into detail on that in just a second. Remember, you can download this chart deck for free by clicking the link in the description. So let's start with quantity. Story number one that I talked about before was that weak demand squeezes volume, requiring price increases to keep revenue on track. The chart that I'm showing shows the average daily package volume of both Express and Ground shipments from 2016 to 2022. And on the right-hand scale, it shows freight volume as measured by average daily shipments. Now, over the past 6 years, FedEx was able to expand its average daily volume of Ground and Express services from 12,000 to 16,000 packages. Its freight segment, which is the green line here, has recovered to pre-pandemic levels and stands at 112 daily shipments. Now, let's continue on looking at this. I got a chart out of the FedEx's annual report that talks about the U.S. domestic package year on year. And what we can see is that the year-on-year comparison of the recent months shows that volume has started to decline. In fact, for example, domestic Express packages volume was down 16% in November. That's really serious negative growth. The management expects weak demand throughout 2023 as well. So we can see volume is weak. Let's talk about price. So for the chart that I have here, it shows the revenue per package for Express, domestic, and international, as well as Ground from the period of 2016 to 2022. And on the right-hand scale, it shows revenue per shipment for freight shipments. The average revenue per package has been mostly stable and flat among all transportation methods. Only freight rates saw good, consistent hikes. Though in 2022, FedEx raised the prices of Ground and Express services to offset inflation effects. But what we can see is that it's not enough price increase to offset the slowdown in volume. So this chart looks at the revenue growth of the company, and basically I would expect maybe 3% going forward for the next few years. So that's my framework for forecasting free cash flow growth potential. We've looked at revenue and we've seen price, rate increases, and surcharge implementation to offset weaker expected volume. And quantity, well, slowdown in economic activity translated into lower delivery volume. Let's look at the next part, which is costs. Remember, you can download this chart deck for free by clicking the link in the description. So this is story number 2. Accelerating cost-cutting program makes margin expansion the key catalyst. Here is a table that the company has presented in their financial reporting. FedEx management has proposed a plan to cut $4 billion in operating costs, which is pretty massive. We can see that they're talking about. For its express segment, it aims to improve the air network by cutting inefficient routes and reducing flights. Let's look at another chart that I've created. In this chart, we look at the 2 largest costs for FedEx. That's cost of service and SG&A expenses from 2016 to 2022. And on the right-hand scale, we show EBIT. Now, it's important to note that FedEx is not a typical company, let's say a manufacturing company, where you have cost of goods sold and gross margin. What you have is operating revenue, operating expenses, and operating profit after that. Now, the EBIT margin has been stable, ranging between 6 to 8%, except for 2020, when it got cut nearly in half. And again, when we're talking EBIT, the company will talk about that as operating income. Its main competitor, UPS, enjoys a 13% operating margin. Hence, there's definitely room for FedEx to improve its margin. It's a question of can they? How aggressive are they going to be? So let's review the cost drivers of free cash flow. Cost of goods sold or cost of services, flight reductions, and focus on higher margin products is a key, and that should be a positive when it comes to increasing the free cash flow potential. And operating expenses, they're trying to reduce workforce and cut back on spending. Again, that's also an increase in the free cash flow to the firm. Let's look at capital. So reducing capital spend could help to improve shareholder returns. The chart that I'm showing shows total capital expenditures from 2014 to 2022. And on the right-hand scale, we show CapEx as a percent of revenue. What we can see is over the past 9 years, FedEx CapEx as a percent of revenue averaged about 8.2%. However, it started to show a declining trend in line with the company's mission to employ capital more efficiently or try to reduce the capital that they have. So the goal is to bring it down to about 6.5 by 2025, which is pretty significant from the 8.2 that they're at as far as CapEx relative to revenue. So if we sum up the capital aspect of free cash flow, there's no significant changes I expect in net working capital, and therefore that's a neutral impact. And capital intensive business, but potential to become more efficient as they're focused on that. That should be a positive impact on free cash flow. So when I sum up my expectation of free cash flow to the firm growth, I think it could be relatively strong, even though the revenue growth is not super high. Let's look at valuation. First, I started off by forecasting the revenue and the NOPAT of the company, and that gives us our free cash flow to the firm. And then we discount that by our estimated weighted average cost of capital. In this case, I'm using 9%. And then after that, we calculate the value of the operating assets of the business, and we remove any net debt and other items to arrive at the value of equity. And then finally, we divide this by the number of shares to come up with our estimated value of $247 versus a share price of $204, which is a 21% upside. So my base case, $247, upside 21%. And for our bull case, we use an 8% rather than a 9% whack to get our $300 valuation with a 47% upside. And then in the bear case, we're going to use a 10% whack to see that it's only going to be at 208, basically flat. So let me wrap up by asking you, can FedEx hit 300 again? Let me know in the comments.